Today I'm going to talk about business owners, and maximizing value leading to an exit. If you've not read the book, The E-Myth, it's the letter E dash myth by Michael Gerber, and you own a business, you should read it because the E-Myth stands for the entrepreneur myth. The entrepreneur myth is if you're really good at something, well, you should start a business that does that something and you'll make millions. Not necessarily so. Owning a business that does something is very different than doing it itself. So today, I want to talk to you about maximizing enterprise value, because what Michael says in the book is don't start a business if you're not thinking of an exit at some point. That business has to have value. If it's just a means to an end in terms of an income where you can save and control your own destiny, get a job. It's a lot easier with a lot less stress. We're talking to people that own businesses today that either understand they need to create value or are going to learn for the first time right now that they need to create value. And I'll start with small businesses. And when I mean a small business, I'm not going to constrain it with dollar signs worth X or sales of Y or numbers of people. Not going to do that. Because in my life, I've seen some really bizarre situations, like single owner businesses worth hundreds of millions of dollars. So not going to constrain it. But let's start with what are called the solopreneur, the sole proprietor, or a small business where kind of one person founded it, one person runs it, one person is viewed as the face of the business. When you're looking to create value for that business, first off, it's all about cash flow. Cash flow, not just last year, but let's say cash flow for the prior 5 years. So you're going to need to make sure that you've had a good 5-year run of financial information where you can show that your cash flow has not only been stable, but growing for the last 5 years. No one wants to buy a stagnant or a business that's even worse. Cash flow is decreasing year over year. In fact, that's a major buzzkill for a buyer. That is, if your cash flow and profits have gone down in the last few years, very unlikely that someone wants to buy a sinking ship, unless, of course, it's a fire sale and they're going to get it real cheap. And that's exactly why we're talking to you today, is to make sure that you don't have that fire sale. So you want to make sure your cash flow is good for the last 5 years. And also the second part of that is you want to have little revenue concentration. What I mean by that is you don't want 50%, 40%, 30% of your revenues coming from one customer or one client. You need that to be diverse. Now, every business has their best customer and a big customer, but again, you don't want it to be too dominant, your cash flow and sales and profitability. You don't want it to be too dominant on any one customer, because God forbid that business folds, sells, moves on, whatever, you're toast. And no one wants to own that. Second part I would suggest is dependability of revenue. And the dependability of revenue, it really means things like, how long have you had your client relationships? Are these clients that you've worked with for years and years and years? Have they grown over the years? So a buyer is going to want to look at that. So you really want to focus on customer retention as much as you do finding new business. That's really a very important part, the durability of that. And is that growth of the revenue, consistent? So, and if it's not consistent, be prepared to explain why. So if customer X, was rising 10% per year in revenue with you, and then all of a sudden it drops off by 25%, be prepared to explain why, because on diligence, someone's going to ask about that. Next thing to consider is the quality of staff. Now, I know a lot of small business owners, sometimes you guys get pretty cheap, and that is you're afraid to hire good help and you don't want to pay too much. And it's kind of a revolving door. So quality of staff is a multidimensional issue. One is they need to be good at what they do, and they need to make you look good, and they need to be really loved by your clients. The second thing is the duration. No one wants to see a firm that's got, high turnover with no company employees that have been there for a while. So quality of staff means duration. It means ability. It means relationships with customers. It also may mean your agreements with them. So if you don't have employment agreements, or you don't have a plan that's going to help them grow, and make next year better for them as well, that's not going to look that be looked at too favorably by a potential buyer. You also want some documentation on exactly what you do, because you're part of the staff. You're an employee, right? And if it's a sole proprietorship, a solopreneur, you want to make sure that your job description and all the details of what you do every single day are really well documented, because a buyer, in that situation is likely to want to step right into your shoes. It's unlikely that you're going to get a strategic buyer who's going to, just send their entire huge management team on your business. It's probably someone that's going to want to step into your shoes. So you need to have every little detail of what you do well documented. And I mean, it could be as simple as, if you're the guy that makes the deposits to the bank, document it. If you're the one that's writing the checks, document it. Now, hopefully you're not, doing that level of work and you've hired someone to take care of that for you. But, that's not always the case. Also, single owned businesses owned by one person, tend not to have a succession plan. And frankly, if they pass away or get really sick, it's a bit of a fire drill and it's not a good situation. So if you don't have a succession plan, because remember, we're talking about voluntary succession here, and that is maximizing the value for a potential exit to add to your nest egg. But the involuntary succession also happens. Involuntary succession, as I said, death, disability, or maybe it's an extraneous family situation that just calls you away from the business. You need to have a plan for that. And it's not just for a buyer, but it's a few other reasons as well. One day, one of your better customers is going to ask you, hey, Fred, what happens if you don't wake up for breakfast tomorrow? Who's going to take over and service our account? Good question. Also for your stakeholders, your family, anyone that's dependent upon you, your employees are going to say same thing. Hey, if you don't wake up for breakfast tomorrow, do I still have a job? And if you do have one or two key people, 3, 4, 5, 1, whatever, the question is, who's going to take over? And if you pass or get disabled without a plan, is it a mad scramble? Are people going to bolt on you, take your best customers with you, and leave you holding the shell of an empty company that's now worthless? So you really need to have that succession plan well thought out, conversations with people behind you that can take it over. And I think let's even talk about a specialty kind of business. Maybe you own a dental practice, let's say, and you're just the solo dude at the dental practice, or lady. And you think, well, there's no one here that can be a dentist. I don't have a dentist in here. I've got hygienists, I've got assistants, I've got administrative staff. Well, maybe you ought to consider finding another sole practitioner in your neighborhood and kind of do an informal agreement with that person that says, hey, why don't we kind of cover each other's back here? And that is, if I break my hand and can't drill teeth, what about you take over for me for a while? Or God forbid, pass away. Let's do kind of a cross purchase agreement, not binding, but let's do something that allows you to come in and buy that thing at a reasonable fair market value so that we can go ahead and continue the business. Every year I seem to not get a call, but I learn about a CPA, for example, that passes away in the middle of tax season. And the clients are like, now what? That's horrible, man. That's a real disservice to your best clients. So you need to have that succession plan for what happens if you don't wake up for breakfast. Also, one way to maximize your value, believe it or not, is to build your savings outside of the business. So if you're thinking that the business is your retirement plan and the real estate that the business is in is your retirement plan, man, guess again. Because first off, not every buyer is going to want your real estate. Now, of course, depending on the business, they may need the real estate to operate it, but not every buyer is going to want your real estate. And the second thing is, if that's really your only asset and you're kind of looking to squeeze every nickel out of it, a buyer's going to sense that. They're going to know that. So they'll know if you're really not well heeled enough to sustain yourself without the business. And then the last part of that is, you're going to get your best price if you're able to kind of spread it out. In other words, be the bank. So if you can sell your business to someone where you maybe take a percentage up front, maybe it's 20%, maybe it's 50%, maybe it's 80%. Depends on your buyer and the size of the business. um, you're going to maximize your price that way. And what'll happen is you'll get what's called an earnout. An earnout means you'll get more money paid to you over the next 1, 2, 3 years based upon a few factors. Number one, client and customer retention, and maybe secondarily, growing. So you may not want to just kind of hang up your spikes tomorrow. You might want to stick around for 6 months, a year, 2 years, and then get even more revenue or a greater sales price for helping that new owner grow that business. So those are all really important issues when it comes to thinking about how you're going to maximize the value. And a last part is your financial records. A lot of solopreneurs, I've seen this in really big single-owned businesses as well, have crappy financial records. I mean, they're dealing with their accountant that was their, buddy in high school or their college roommate who runs a sleepy little practice and doesn't charge you a lot because you're friends. And guess what? When they don't charge you a lot, unfortunately, they ain't doing a lot either. So you're really getting nothing but the bare minimum. So if you get an annual tax return done, maybe a financial statement, but probably not a financial statement, you're going to think about upgrading that. And I would say expand that to your other financial relationships as well. And that is a banker, an accountant, insurance person. Make sure that all of these professionals have kind of done their job and dotted the I's and crossed the T's. So what would you need the lawyer for? Well, maybe employment agreements, maybe that potential purchase and sale agreement with someone that's going to cover your back in the event you don't wake up for breakfast. Maybe you want to give phantom stock to key employees. With, key employees, you want them to stay after the sale. So giving them a little piece of the action on the sale or a stay-on bonus is frequently a good idea. And a banker is important because, well, what if the buyer needs financing? It might be the easiest path for that buyer to get financing if you've got a banker that knows your business, trusts your business, and views it as a bankable asset. So again, these are just some simple ideas for you solopreneurs, your single-owned businesses that you can maximize value on exit. Let's move up the food chain a little bit and let's talk about similar topics, but let's talk about a larger business. And I'll define a larger business as a business that maybe has several employees, dozens or more, maybe more than one owner, maybe 2 owners, 5 owners, 10 owners, whatever it might be. And a business that's going to sell for, let's say, a multiple of EBITDA. By the way, EBITDA, earnings before interest, taxes, depreciation, that's kind of the basis for how businesses are valued today. And if you don't have much for earnings before taxes, depreciation, interest, good luck selling your business. It's going to be a fire sale. So we want to make sure that your larger business has dependable earnings, just like a small business, over an extended period of time. What's that extended period of time? Minimum of 5 years. Absolute minimum of 5 years. And defining that larger business means that, there's needs for governance. There's ways that those businesses make decisions that are more than just the owner. And that is a really important issue when it comes to your value, is seeing that you're kind of a systems driven business and it's governed well, as opposed to a dictatorship, a sole proprietorship where one person's making all the decisions. A buyer for that kind of business wants to see that there's other people that have influence, that the loss of any one person is not going to kind of crush the business down to its knees. So you need to develop other leaders. You may not have them right now, but understand that's really an important part. You need to develop those leaders. And these are people, again, that need to run independent, interdependent, both from you, the owner. So the business that shows a little bit of independence from the founder is also going to show some durability. And the durability is important for a buyer because, again, they don't want to buy a pig in a poke, right? They want to buy something that's going to be as good tomorrow as it was yesterday, the day before the closing. Let's go on to accounting and books and records. Have you ever heard of a quality of earnings report? quality of earnings report is a report done by CPA firm typically, and the CPA firm is going to report on, well, how consistent, how good are your earnings, and how would they, expose the vulnerabilities of revenue, the risks to your revenue and profitability, et cetera. Quality of earnings report is not cheap, but you're going to need one in order to sell. Your investment bankers are not going to take the case unless you get a quality of earnings report done. So my advice, get a quality of earnings report done several years before you're thinking of going to market, because in that Q of E, they're going to not only tell you what's good about your business, but they're going to expose the weaknesses and the gaps in where you are currently. Frequently, one of those gaps is your accounting and record keeping. So you may need to upgrade your accounting firm and upgrade the level of financial scrutiny that's going on inside the company. Also, it's common for you small business guys to kind of have a lot of expenses, let's say, that a new owner would not incur, whether it's your country club dues, cars for officers, and expenses that might otherwise be considered personal by some companies. So you want to highlight those, cleanse those, and make sure that you can eliminate them, frankly, or at least call them out for the past 5 years, because that's how carefully a buyer is going to take a look at that. So again, that quality of earnings report, really important. It's going to identify a lot of gaps and things that you can do. You're also, when you're looking at selling a business that's a little bit larger, you're going to need an intermediary. Absolutely going to need someone. An intermediary, not just a lawyer and an accountant. I'm talking about an investment banker. And when it comes to hiring an investment banking firm, not a business broker. Business brokers sell sub shops, pizza shops, and hairdressers. I'm talking about an investment banker who's got experience with valuations, has a knowledge of the marketplace, and perhaps even a specialty in your area. So as you're going to talk to bankers, again, I would do that 3-4 years before you're thinking about your planned exit. You want to make sure that you're dealing with someone that has A, transaction volume, B, experience in your space. You want them to know your industry. You want them to know the buyers in your industry. And it's okay to ask them, so who have you worked for? They're proud to talk about their portfolio and show you their kind of listings of what they've sold, et cetera. Once it's sold, they can talk about it. When it's, before it's sold, it's kind of confidential and they don't want to talk about it. And that makes a lot of sense because you don't want them out blabbing about you 4 years before you're going to market. That's the biggest fear a lot of business owners have. My customers learn I'm going to sell. Now what? You want good financial records. We talked a little bit about that earlier, but you want really good financial records and accounting systems. And those systems probably are going to need a little bit of an upgrade. If you're dealing with reviewed financial statements or not even compiled financial statements, you might want to move up the food chain and get them reviewed. If the business is big enough, let's talk about a business with over 10 million in earnings, let's say, you might want to consider getting an audited financial statement, audited by a CPA firm. Yeah, I know, dude, it's going to cost you a lot of money, but it may save you or make you a lot of money on the back end. So does a quality of earnings report, by the way. I've seen Q of E reports help, goose up sales price substantially just based on the information that was kind of disclosed. Another thought is, don't miss the boat. And what I mean by that is a lot of owners stay a little bit too long at the punch bowl, and they're thinking, hey, if I'm making X on this business and I'm only going to sell it for 5 or 10 times X, why the heck would I get out? I can work another 5 years and then, have the same as if I sold it and still have the business. Well, really take a look at your industry carefully. Look at cycles and look at your level of engagement and the trajectory. Where's your business going? Where's it headed? Don't miss the boat. And by the way, it doesn't have to be a wholesale, right? When I say wholesale, I mean a 100% sale. You might find a buyer for half of your business or 70% of your business, retain a little bit yourself, still have your job, still collect dividends from the profits, and now have someone all fired up that just paid good money for a minority to majority interest in your business who really needs to make that business worth more money than they just paid for it. For my clients that have done that, in many cases, we'll call that the second bite at the apple, turns out to be way bigger than the first bite of the apple. Yeah, actually, finally selling your 30% stake could get you more than the first 70% stake that you sold. So don't think right away that you're going to wait till you're 70 years old or 65 years old, you're going to sell 100%. You may consider selling a portion of that business long before that. And that's another way to maximize value. Well, we've talked a lot about value, and maybe a good place for you to start today is go get a business valuation. If you've never had a formal valuation done, shame on you. Shame on your financial advisors, really, and your lawyer, because you can't do a good estate plan or even a financial plan without a solid business valuation. So start with a valuation. I'd even do that before I did the quality of earnings report. And much like a quality of earnings report, the business valuation is going to expose the strengths and weaknesses of the business. Yeah, it's going to cost you money, but it's probably worth it in the long run. It's all deductible money anyway. So I would go out and get a valuation, again, years before. The investment banking firm you choose will do a valuation as well, of course. But I would get an independent firm, not an investment banking firm, could be an accounting firm, but there are companies that just do business valuations. I can think of a few that we use frequently in our firm. Go out and get that valuation done sooner than later, and have some targets in mind based on that valuation. Plus, it really is an important part of your financial plan. Knowing what your financial independence looks like post the business, post your exit, is really a significant part of helping you decide when to exit. Some people love their business so much, that's all they want to do. But some of you have a real life and you have other things that you want to get done as well, whether it's play more golf, visit the grandkids, travel, pick your poison. Lots of cool stuff to do in this world, and it ain't all work, right? So you might want to think about that valuation and its impact on your financial plan a little bit sooner than later. So I think that's probably enough to get started here for today. I appreciate your time here. If you have any questions about the business valuation, quality of earnings reports, and other little tactics that you might do or might already be doing, you'd like to bounce them off me to talk about how you're, the track you're on, are you doing the right thing? What else can you be doing? Feel free to reach out to me. You can find me really pretty easy right here or at Napier Financial. Not a problem. Thanks for your time. We'll see you again soon.